Do you think the Fed, they said this last week was a big game changer? Does it change everything in the markets now?
Well, I think there's a debate going on, clearly. I would tend to tilt towards the message communicated at the FOMC rather than a sole Fed governor on Friday. In other words, I do think that the reflation story from a fundamentals perspective remains firmly in play. It seems to me only natural that we would anticipate moderately higher bond yields from current levels, and clearly that has an impact on a whole range of risk assets. My sense is the Fed continues to focus more on the labor market and actually imbalances in the labor market than inflation right here, right now. But the reality is inflation is the obverse to growth. And I think ultimately these are good problems to have.
Good problems to have. Our question of the day still remains about that yield curve, though, and why we're seeing yields drop so dramatically towards the long end of the curve. How much flatter do you think we can get, John, and what assumptions are you making here on why we've seen this move?
Well, look, I think there was a lot of extraordinary news priced into the market in terms of growth and marginal intervention by the Fed. That clearly was never going to be the case. At Credit Suisse, we had the view, and still hold the view, that the Fed will likely move in 2023, which suggests, we have another 18 months or so, possibly 2 years before the Fed start to take action. So I do anticipate there will be a period of choppy sideways trading as the volatilities associated with this debate in the Fed are reflected in pricing. But absolutely, I take the view that yields will tick a little higher. And let's not forget that actually the US economy is anticipated to grow at sort of China levels this year. At Credit Suisse, we have that forecast at around 7%. It's almost inevitable that you should have some inflationary pressures developing as a consequence of that. But remember this important phrase, transition, temporary price pressures. I do think that actually we are likely to see a moderation in price pressures within the next couple of quarters, and I think once that happens, a concern about yields and inflation will likely moderate.
Okay, and John, what you've just outlined there, of course, supports your view that there is this intact reflation trade still to be looked at. Where, in terms of which markets are most in favour for you when it comes to that cyclical trade then?
Well, in developed markets, we're very much focused now on Europe. In our view, the growth acceleration in Europe is essentially a new phenomena versus the priced-in growth impulse in the United States. And the reality is Europe has only a modest weighting and proportion in growth. It's much more of a value play. It's much more of a cyclical stock market. And so consequently, the likes of Germany, the UK, even Spain, we are now focused on, we're recommending. And of course, the cyclicals, the materials, the industrials, in particular, the financials are those sectors that we are recommending to clients.
Okay, John, what about over in Asia then? Because if you look at the MSCI Asia Pacific Index, it's essentially done nothing since about the end of February. Do you see much upside here?
The good news in Asia is that earnings are improving, and as you correctly point out, prices are remaining stable. In other words, valuations are improving. Valuations were insanely expensive in the last quarter. I would describe them only as expensive in this quarter. And I do think valuations will moderate into the second half of the year. In terms of markets and sectors, we're very much focused on value, on cyclicals, and in particular, we like Korea. Which is largely a function of the so-called new oil, the semiconductor story, which clearly is driving earnings there in quite a powerful way. We anticipate further upside in the Korean equity market as a consequence and are overweight. Other markets that we are recommending to clients in Southeast Asia are Thailand. That's a value story that's very much associated with oil and underlying quality. We think on a risk-adjusted basis, it should be explored.
And John, I mean, why do you think commodities are falling out of bed now? I mean, is it more about a growth scare that perhaps after this pandemic-induced growth? We're going to see things fade away quite quickly. Is it a factor of inflation? Hedges are being unwound. What do you think is happening there?
Well, if you look at the chart of commodities over the last 6 or so months, it was parabolic, and I think it's only natural to anticipate something of a correction, something of a pullback from that extraordinarily overbought situation. But yeah, once we are seeing this anticipation of supply chains repairing and some of the imbalances in labor markets improving, then almost certainly you will start to see some prices coming off, in particular industrial metals and some of those commodities which received the highest price appreciation. Just to say, though, oil we do feel has the potential to move a little higher ahead in the next 3 or so months. I would expect Brent to get up to that sort of 75 level. But thereafter, I think it becomes quite expensive, fully priced, if you will. And subsequently, over the next 6 to 12 months, we see the price pulling back to the sort of the 65 level. But I think largely the commodities is a correction in an extremely overbought market. And at Credit Suisse, just to say, we've actually neutralized our commodity exposure now, bringing it back to strategic benchmark weights.